Hello, and welcome to today's reverse mortgage video. My name is Mo Nelson, and I am a mortgage loan advisor with C2 Financial. Today I would like to discuss making sense of reverse mortgage guidelines. Reverse mortgages can sometimes feel overwhelming, especially with all the guidelines in place, but today we are going to break it down step by step. We will cover the history of reverse mortgages, important guideline changes, and some additional borrower benefits. Let's dive into the history first. Did you know that the very first reverse mortgage was funded back in 1961? It was created by Nelson Haynes of Deering Savings and Loan in Portland, Maine. The loan was designed to help a widow, Nellie Young, stay in her home after her husband's death. For the next 15 years, this concept gained traction, and by the 1980s, the government recognized the potential. Senator John Hines introduced a proposal, and in 1988, President Ronald Reagan signed the Housing and Community Development Act, officially launching the FHA-insured reverse mortgage we know today as the Home Equity Conversion Mortgage, or HECM. Now, let us move on to four major changes or modifications that have been implemented since the launch of the modern reverse mortgage. The first major change was the non-recourse feature. Early versions of reverse mortgages lacked protections to prevent borrowers from owing more than their home was worth. With the FHA-insured reverse mortgage, borrowers are now guaranteed that neither they nor their heirs will have to pay back more than the home's value at the time of sale. Next, there is the non-borrowing spouse protection. In earlier versions, if the borrowing spouse passed away, the younger non-borrowing spouse could face foreclosure. Now, if the younger spouse meets the loan terms, they can stay in the home without facing foreclosure. Another critical change is mandatory counseling. Every borrower must attend third-party counseling to ensure they understand the loan terms and that it is the right fit for them. This added layer of protection helps borrowers feel more confident about their decisions. Lastly, we have the 95% option. This allows heirs to buy the home for 95% of its appraised value after the borrower's death, even if the loan balance exceeds the home's value. This offers families more flexibility when deciding what to do with the property. In addition to these four major changes, there are other important milestones to consider. For example, in 2004, HECM refinancing became possible, allowing borrowers to access additional equity. And in 2009, HECM for purchase was introduced, which allows seniors to buy a new home using a reverse mortgage without a monthly mortgage payment. There is also the initial disbursement limitation from 2013, which prevents borrowers from taking out all their available funds at once. This helps protect both the borrower and the FHA's Mutual Mortgage Insurance Fund. Now, let us wrap up with a few additional rewards that borrowers can benefit from today. One of the excellent features of reverse mortgages is the line of credit growth. As long as the borrower leaves funds in the line of credit, the available amount grows over time, offering more flexibility down the road. Borrowers also have the option to change how their loan proceeds are disbursed after closing. Whether they need a lump sum, monthly payments, or want to switch to a line of credit, these changes can be made without refinancing. I hope this video has given you a clearer understanding of reverse mortgage guidelines and how they have evolved over the years to better serve seniors. Thanks for joining me today. If you have any questions or would like to learn more, feel free to reach out. Have a wonderful day.